Each could limit the startup's flexibility. 3. Crowdfunding. Crowdfunding is a popular type of funding where startups raise capital from a large group of people through online platforms such as Kickstarter, Indiegogo, and GoFundMe. Crowdfunding provides startups with the opportunity to get pre-orders or donations from people who believe in their vision and mission. With the opportunity to get pre-orders or donations from people who believe in their vision and mission. Advantages. The advantage of crowdfunding is that it offers a low-cost funding option for startups who are just getting started. Crowdfunding provides startups with validation from potential customer, which can help boost sales. Disadvantages. The disadvantage of crowdfunding is that it may not be the best funding option for every startup. It requires a lot of planning, preparation, and marketing to execute successfully. 4. Accelerators. Accelerators are programs that provide startups with a range of services in exchange for equity. These services include funding, mentorship, and business development support. Accelerators typically LSD for a set period, around 3 to 6 months. SD for a set period, around 3 to 6 months. Advantages. The advantage of accelerators is that they provide startups with valuable mentoring, networking, and business development support. They also offer funding, which can help startups achieve significant traction in a short amount of time. Disadvantages. The disadvantage of accelerators is that they often require a significant amount of equity. Factors considered in obtaining funding. When it comes to raising capital for your startup, several factors are considered. These include your business model, revenue growth potential, market size, and competition. You should also consider our team's abilities and experience, transparency, and communication skills. Below are the key factors considered when raising capital. Our team's abilities and experience, transparency, and communication skills. Below are the key factors considered when raising capital. 1. Business model. Your business model is a critical factor considered by investors when evaluating your startup for potential investment. A good business model must demonstrate how your startup plans to generate revenue and achieve profitability. 2. Revenue growth potential. Investors are always looking for startups with high revenue growth potential. You need to show investors how your startup plans to grow its revenue substantially in the short to medium term. Investors are not interested in startups that have a limited revenue growth potential. 3. Market size. The size of the market is a significant factor that investors consider when evaluating a startup. Investors are interested in startups that have a large market size and potential for growth. 4. Competition.